Also, earnings season nearly wrapping up. Overall profits for the S&P 500 companies declining more sharply than any quarter since 2009. Jack McIntyre's whether we should be worried or not. Jack, you're concerned about this market, aren't you?
Well, I'm concerned, and I would be increasingly concerned if the U.S. dollar was to power ahead based on the Fed tightening too aggressively. But you're right. I mean, earnings, the rear view sort of look, earnings are bad, but I actually think they might turn a little less bad going forward.
Yeah, well, I think, well, without a doubt, the comparisons are going to be easier. But
yeah.
What do you make, then, of the Fed signaling so much? And these aren't just hawks. I mean, these are a variety of Fed officials signaling a rate hike, trying to justify even a June rate hike. Where's that coming from?
Right. So I think you make a good point, because to me the best way to get information from the Fed is when you see a dove sound hawkish or a hawk sound dovish. So, yeah, clearly they want to kind of build up market expectations to that, hey, don't forget about us. We can tighten. I guess I would make the argument, though, that if the Fed is tightening because the underlying economy is doing okay, that's not necessarily a bad environment for risk assets. We've seen prior to 2008, when the Fed was tightening, the key going slow, equities did well. I suspect we could see the same sort of environment now, but just, again, the key is the Fed's got to go slow.
Right.
The U.S. dollar can't power ahead.
So, Jack, then that's essentially the epiphany Wall Street probably had this week with some of the economic data, particularly housing, because this is the best week we've had in a long time. The market's up, and we still believe that the notion that the Fed's going to hike rates June or July, that's increasing.
Yeah, you're right. But, again, the point about housing, I think, is very, very important because, in terms of GDP, it's not a big part of the economy, but it punches above its weight. It flows through to consumer confidence. We need to see the consumer remain confident. We need to see, sort of retail sales, consumption stay pretty robust. But, I think we're kind of in a world, I'm not going to get too excited about the return potential. I don't want to get too positive. I don't want to get too negative in here as well.
Well, what do investors do? Because we've had a really good run in the stock market rally since the lows of March of 2009, but it's stalled, and we're trading in a range right now. We're range-bound. There's a few winners, but losers are punished severely, in my mind, overly punished. So what's the average investor to sort of do? What are you guys doing in this? You're not the average investor, but what are you guys doing?
Well, so we've got our portfolios, and again, I'm on the global bond side, but, it's pushing us towards yield, because I think the way I view things, that we're not going to be in a risk-off environment. It's risk-neutral or risk-seeking, and in that type of environment, capital is going to gravitate towards risk assets. So I think actually equities are going to do okay. Again, I think, as you pointed out, it's been a powerful bull market. We've consolidated. But to me, we're consolidating, setting the stage for another sort of push higher. Getting the timing right is certainly going to be challenging, but I would take a little bit of a longer-term perspective in here. I wouldn't trade this market.
By the way, real quick, Jack, I want you to know we just got word that Janet Yellen just now saying at this moment that a rate hike would be appropriate. So everyone at the Fed on the same page. Okay. The market, the Dow was up around 31 points when we started this interview. It's up 11 right now, so it's not panicking. And it's back to your point. If they can justify this, not as some sort of a contest over wills between the Fed and Wall Street and which one is a tail and which one is a dog, but something that's legitimate, maybe Wall Street can accept it. Do we have to wait until Friday, that jobs report, to really understand whether or not the Fed is making a mistake here?
Well, I think, the fact that she actually mentioned what you just said, I think is very important, because, the risk with the Fed is that they don't want to surprise the markets. So they're being very transparent. The fact that you have Dudley and now Yellen on the same page in terms of bracing the markets for a rate hike, unless it's a really disappointing employment report, I would suspect that it looks like they want to move. I'm not still sure if it's a June or July. You've got the Brexit issue you've got to deal with as well.
But then again, it wouldn't be that much. It would have to be June or July, because I think they'd be loath to do it on the eve of a presidential election. But having said that, do they have to make it clear? Do they have to articulate to Wall Street? Because we know Wall Street's going to whine, they're going to complain, they're going to sell, they're going to do whatever they can to persuade the Fed to stay as accommodative as possible. So do they have to articulate one and done?
Well, see, that's a good point, again, because I think there's some balance. Because what happened in last December when they tightened, well, they didn't sound very dovish after that. They did the trial balloon of tightening 4 times this year. They cannot do that again. They've got to tighten, but they've got to kind of send a message, hey, we're going to go slow. We don't see a lot of inflation pressures. Because if they don't, we know, the market tends to get ahead of the Fed, and they're going to price in a little bit more of aggressive rate cycle. That's why I think the Fed's got to send a clear message. They're going to go slow. And I think risk assets, equity markets will be okay.
Jack, thank you very much. Appreciate your expertise on this.